Good morning, everyone, and welcome back to the Daily Hunt for Multi-Baggers. It's Thursday, January 29th, 2026, and we're ready to break down all the market chatter from yesterday, January 28th.
That's right, Ethan. Our AI has been busy sifting through a massive volume of social media discussions. We've seen a surge in engagement, particularly around some major tech players following their earnings, alongside some smaller, high-risk names. Overall, the market sentiment is a real mixed bag today. Plenty of promising growth stories, but also a good dose of skepticism and outright bearish predictions.
All right, let's jump right into it. First up, we're talking about Intel, symbol INTC. Now, the buzz around Intel has been fascinating. We've seen reports of potential NVIDIA and Apple orders that sent the stock climbing, and analysts like Jim Cramer are expressing confidence in a turnaround. Plus, there's been some insider buying, which always signals a belief in future potential from those closest to the company.
Well, Ethan, while that sounds promising on the surface, our AI-generated insights are flagging some serious red. Intel's current financial KPIs are still painting a very challenging picture. We're looking at negative revenue growth, a negative net profit margin, and negative earnings per share. And get this, a debt-to-equity ratio of over 37. That's extremely high, indicating significant financial leverage and risk, despite any new order buzz. Our previous ratings for INTC have consistently been stay away, and unfortunately, despite the recent positive news, those underlying fundamentals haven't shifted enough. So, given those deep-seated issues, what's our verdict for INTC today? For INTC, we're sticking with a stay away. The fundamental weaknesses outweigh the speculative upside of future partnerships right now.
Understood. Next, let's talk about Intuitive Machines, LUNR. This one's got a lot of community excitement, primarily driven by the anticipation of a major LTV contract. Users are insanely bullish on this, and there's even talk of a short squeeze possibility, with over 25% of the float short. Analyst upgrades and projections of the company being worth $4 billion by mid-2026 certainly fuel that optimism.
It definitely does, Ethan, but the KPIs here are screaming caution. Intuitive Machines is currently unprofitable, with negative revenue growth, a deeply negative net profit margin, and negative earnings per share. And that debt-to-equity ratio? It's a staggering 152. That kind of financial leverage, especially for an unprofitable company, is incredibly risky. While securing that LTV contract could be transformative, it's still a future event. Our AI insights show that LUNR has mostly been rated stay away or speculative gamble previously, and those financials haven't improved.
So for LUNR, it sounds like we're still in a high-risk zone.
Absolutely. For LUNR, it's a stay away for general investors focused on fundamentals, but we acknowledge the very high community optimism for a speculative play.
Okay, moving on to Carvana, CVNA. Now, this one's been a roller coaster. Some users have been consistently betting against it, but others are pointing to a resilience, noting that it's often bounced back after past fraud reports. There's always a lot of chatter around its high growth potential for those who believe in the model.
Ethan, that resilience is a tough sell when you look at the hard data. Our AI analysis shows an overwhelming bearish sentiment, primarily fueled by Gotham City Research's claims of fraud, a reported $1 billion accounting gap, and questionable ties to lenders. The stock plummeted 20% on the day. Carvana's PE ratio is still sky high at over 93, and its debt-to-equity ratio is an astronomical 192. But perhaps the most damning KPI is the significant insider selling, with over 25% of shares being net sold by insiders over the last 6 months. Those closest to the company are divesting, which, is a strong signal. CVNA has mostly been a stay away or speculative gamble in our past market commentary.
With those strong allegations and insider selling, I imagine our verdict remains consistent.
Yes, for CVNA, it's a definitive stay away. The risks are simply too high.
All right, let's talk about MP Materials, MP. This stock has experienced some turbulence, but the rare earth mineral sector is strategically important, and there's always potential for future growth in an evolving geopolitical landscape.
Well, that's the optimistic view, Ethan, but our analysis shows deep-seated problems. MP Materials is grappling with negative revenue growth and deeply negative profitability metrics across the board. We're talking about a net profit margin of negative 50% and negative EPS. The U.S. shifting away from critical mineral price floors and a massive government investment in a rival company are significant headwinds. MP stock already dropped 8.8% on that news. We even had a buy rating for MP previously, but this recent data has forced a clear downgrade.
So this is a tough one for MP.
It is. For MP Materials, we're advising a stay away. The financial and competitive pressures are too severe.
Next up, a real favorite on the show, Micron Technology, MU. This stock has been on an absolute tear. Users are celebrating massive gains, with some talking about a 10-fold increase and projecting market caps of 1 trillion or even 1.5 trillion. There's incredible momentum, and news about capacity being sold out for 2026 just adds to the bullish sentiment.
Ethan, while the PE and PB ratios are high, suggesting a premium valuation, Micron's performance is, well, pretty impressive. The revenue growth is robust at over 56%, and the net profit margin is a healthy 28%. More importantly, we're seeing significant insider selling, over 31% net shares purchased by insiders over the last 6 months. That's a huge vote of confidence. Given its solid fundamentals, strong industry tailwinds, and management's moves to increase capacity, it's a solid upgrade from any previous stay away or speculative gamble ratings.
This sounds like a strong candidate, Brooke.
It absolutely is. For MU, our AI-generated insights classify this as a buy.
And now the commodity that's always a hot topic, gold, symbol gold. The gold rush is on, with gold hitting historic highs over $5,300 an ounce as the dollar weakens. Many are seeing it as the ultimate safe haven, with some bold predictions even reaching $10,000 by 2026. That's some serious optimism.
It is, Ethan, but we have to separate the commodity from the company. While gold prices are indeed soaring, Gold.com's KPIs are frankly alarming. We're looking at an astronomical PE ratio of almost 180, an extremely thin net profit margin of 0.00062, and very low earnings per share. This means the company isn't efficiently translating those high gold prices into significant profit. Add a high debt-to-equity ratio of over 180, and you've got a stock trading near its 52-week high with very weak underlying fundamentals. This is the first time gold has appeared on our podcast, and the current valuation suggests extreme caution. So despite the shine of the commodity, the stock itself is a different story. Indeed, for gold, we are recommending a stay away. The valuation is too disconnected from current profitability. Next, let's look at Tesla, TSLA. Post Q4 earnings, there's a wild debate. Despite some perceived sales misses, the stock continues to rally. Elon Musk's pivot towards physical AI, Optimus robots, and the promise of a tsunami of new product launches certainly capture the imagination and hint at enormous future growth beyond just cars.
Well, the imagination is certainly at play here, Ethan, because the numbers are quite stark. Tesla's PE ratio is sitting at an almost unbelievable 293, and its price to book is over 17. Users are pointing out that while the stock might go up, the company is literally selling no cars and hemorrhaging money if you look at core automotive. While revenue growth is technically positive at 11.6%, it's nowhere near what you'd expect for a company with such a valuation built on highly speculative future ventures. TSLA has mostly been a stay away or speculative gamble in our past market commentary, and the current situation with the stock already pricing in so much future success makes it incredibly risky.
So the futuristic vision doesn't quite align with the present metrics for most investors.
Exactly. For TSLA, it's a firm stay away. The valuation demands too much future perfection.
Last but not least, Microsoft, MSFT. This tech giant recently topped Q2 earnings and revenue estimates, and analysts are reiterating outperform ratings. Their massive investments in AI, especially through OpenAI, are clearly a strategic play for long-term dominance. Plus, we've seen significant insider buying, which is always a good sign of confidence from within.
That's true, Ethan, but the market's reaction has been cautious. Microsoft stock actually dropped after earnings due to concerns about softer Azure momentum and higher capex. Many users are skeptical about OpenAI's valuation, some even calling it a bailout. Google's Gemini is also emerging as a strong competitor, and Apple opting for Gemini over ChatGPT is a significant competitive signal. Despite strong revenue growth and net profit margin, that high PE of 30, coupled with these massive high-cost AI investments and competitive pressures, means a lot needs to go right to justify the current price. We've given MSFT buy or cautious buy ratings in the past, but the current market dynamics are signaling a downgrade.
So even for a titan like Microsoft, there are headwinds?
Definitely. For MSFT, our AI-generated insights lead us to a stay away for now, pending clearer returns on those enormous AI investments.
And that brings us to our roundup for today's hunt, Brooke. What's our final list for deeper analysis?
All right, here are today's top candidates based on our AI-generated insights and market commentary. Investigate as buy, Micron Technology Inc., MU,
Meta Platforms Inc., Meta, Investigate as Cautious Buy, none. Investigate as Speculative Gamble, Intuitive Machines Inc., LUNR.
And that's all the time we have for the Daily Hunt for Multibaggers today.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for joining us, and we'll catch you tomorrow for another Daily Hunt.